Top pick number one, Baytex Energy.
So as backdrop, we believe we're in a structural bull market for oil where oil is going meaningfully higher. So we're looking for names to give us maximum exposure to that. With Baytex, we get a company that has drilled 9 of the 10 top wells in the most economic play in all of North America, trading at 1.9 times cash flow and a 38% free cash flow yield. They've pledged that they're buying back stock now, they're paying down debt. By this time next year, we're going to be getting our 75% of their free cash flow, which translates into their ability to privatize the company in not that long. We think, given the pedigree of the play that they now have massive exposure to, that the street still is asleep to putting a proper value. We think a 5 multiple on their cash flow at $100 oil is reasonable. That gives us a target price of $18 or potential upside of about 180% right now. And so it's, in our opinion, an extraordinarily mispriced stock.
MEG Energy. Why do you like this one?
This is the easiest story to understand. It's a single asset company where I get 35 years of inventory and I'm only paying for 2.7 of them. And so I'm getting 32 years of free cash flow for free, and that free cash flow amounts to a 33% potential dividend. They're completely aligned with investors. We're getting 25% of it now. Next quarter, I think we'll start getting 50%. By this time next year, we're getting 100%. And so you get a 32 years in a company of 33% per annum free cash flow. So either maybe a 20% buyback per year, they chart their plan to privatize, and it's 13% dividend, some combination thereof. So for the 35-year asset in what we think will be the most exciting bull market for oil in modern history, we think a 6 multiple is appropriate. That gives us a $42 share price or potential 143% upside from here.
Sorry, just give us that number again. What did you say? You're getting 30 years of cash flow free.
Yeah, they've got 35 years of stay flat inventory, so booked reserves, and then on an enterprise value to cash flow. So we use their market cap plus their debt. It's only trading at 2.7 times cash flow. And so we say, okay, well, we have 35 years of inventory. We're paying for 3 of them. So we get 32 years for free. And each year they generate free cash flow equivalent to 33% of the market cap right now. And so they've said, look, once we hit our ultimate debt target, which we have modeled Q3 of next year, you're getting 100% of that. And so, like, what do you do with all of that free cash? You know, you could pay a dividend, but then you're going to be buying back a lot of that stock. And we think the meaningful return of capital through buybacks drives that re-rating, because what's the value of the very last share of a company free cash flowing a couple $1 billion a year? And so if you tell the street, this is the path, by retiring stock every year, you must force the price of your stock up so long as the oil price hangs in, which we think will happen.
And your final idea, Enerplus. Why is this one of your favorites?
Yeah, so Enerplus's board recently committed to at least 60% of free cash flow going to share buybacks and dividends this year and next year. We think, and on the conference call, they mentioned that they'll entertain a significant issuer bid Q4 this year, where they could buy back 10% plus of their stock in addition to their NCIB, which they're buying back 10% of their stock. Why would they want to do that? They're trading at 1.6 times cash flow and a 39% free cash flow yield. And so you're getting a clean story, debt-free next year, 2 single assets, US Bakken and the Marcellus. We think a 5 multiple is appropriate for this name. It's a $42 potential target price at $100 oil and strip gas, which is about 200% upside for here. And so it's reflective of an industry that is woefully mispriced. People are getting over the trauma of enduring the worst bear market in history. But what's different now is growth is in the past. Every single company, or 99% of public companies, have pledged, they've codified that they will not meaningfully grow. Instead, they will maximize free cash flow and give it back to us. And so that is the catalyst to allow names trading at 1.6, 1.8, 1.9 times cash flow to get re-rated, I think, closer to 4 to 6 times. And so we've had the sharpest drawdown, sell-off since COVID, March of 2020, over the past 2 months. In the not too distant future, the SPR ends, seasonal strength in oil, and the continuation of modest growth coming out of US shale and OPEC spare capacity exhaustion. So we think the setup in the coming months, quarters, and years is phenomenally strong.
Eric, I know it's hard to generalize, but are the prospects stronger for Canadian natural gas producers or oil producers over the next 6 months, say?
Yeah, I think the outlook for oil is a little bit better. If you're looking at the spread between AECO pricing and like Henry Hub, it's been widening. I think strip is about 850-ish for gas for US, and it's in the fives as of this morning for Canadian gas. So there is a bit of a spread. We're not getting the full windfall. It will have taken us 14 years to get a molecule gas via LNG, where it took US less time to land a man on the moon with the computing power less than a modern day cell phone. And so we're a bit behind the curve. And as a result, we don't get the full benefit of international pricing, nor do Canadian taxpayers via increased taxes and royalties.